So now, having done the amortization on existing right of use of assets, for the new amortization on right of use of assets, it's just going to be the principal repayment for the new right of use of assets. So essentially, we are taking the lease payment on existing lease liability, what we did for the amortization on existing right of use of assets. We take the lease payment on existing lease liability, and then we deduct from that interest expense that was included in that lease payment, because you just want to account only for the principal repayment. So we do the same thing here. So either we can just we can take the interest, and then we deduct from the interest the lease payment on new lease liabilities. So we can do that, or we could just reference to the total principal repayments, which we calculated here for the new additions. So that's another way of doing it. So it's just a plug. Let's just reference that there, and we have that in place. So for the total amortization expense, it's going to be the sum of the amortization for the new right of use of assets plus the amortization on the existing right of use of assets. So for the right of use of assets, ending balance is going to be equal to, we take the opening balance, we add to that the additions, and then we deduct the total amortization expense. So this later one, we fill in our balance sheet under the operating leases. So we can fill this all the way to the end of the projected period. So as you can see, we have been able to model this up to this point. So we are done with the finance leases and operating leases schedule. So we want to move now to modeling our property, plant, and equipment schedule. So we want to move on to modeling our property, plant, and equipment schedule. So in order to do this, we will get the property, plant, and equipment for the historic period. We're going to get the ended balance for that from our balance sheet. And then we'll also get the capital expenditures we get that also from the cash flow statement. And then we will just get the other net additions that by just reverse engineering the property, plant, and equipment closing balance as a result of that. We also get the total depreciation expense. So we're going to be having all of these bringing in. So for the total depreciation expense, we will have to grab the total depreciation from the cash flow statement, and then we will also adjust that to the depreciation that was made when we calculated the finance leases. So let us begin. In order to do that, let us grab, we can grab your property, plant, and equipment balance from the balance sheet. You can fill this right to the end of the historic period. Since it's a cost-co calculation, the opening balance of the current period is the closing of the prior period. And then let us grab from our raw data tab whatever the opening balance was for the year 2016. We can go to the raw data tab, and we grab from the raw data tab under the supplemental balance sheet information. We have here the opening balance, not including capital or finance leases. So we have that opening balance there. We can just have that as a block. While we fill this right with Control R. And then for the capital expenditures, we already have that set up for us in our cash flow statement. So it's gonna be the sum of the proceeds and the purchases of property, plant, and equipment. So this sum of the proceeds and the purchases. So we're just netting that off. Switch the sign to make it positive. We can fill that right to the end of the historic period. So we have that in place.